everyone. Welcome back to The Lens, hosted by Craig Shapiro and Larry McDonald. This week, we're going to sit down and hear what are the institutional investors thinking about. We host an institutional live chat on Bloomberg with more than 660 investors in more than 23 countries. We have around 150 contributors that give us the best ideas, and today we're here to share them with you. Larry, Craig, go ahead.
Thank you, Valentina. Have a great weekend. Great job this week, the whole team in New York. Um, Special thanks to Jose and the team for setting this up. And so, Craig, let's walk through the week. The feeling that I'm getting from investors in the chat is that the beast in the market broke the White House 4 weeks ago, and the White House capitulated and then threw about 7 fire hoses at the market, created a lot of short covering. Beautiful. The momentum players started to come in. Higher prices bring out buyers, lower prices bring out sellers, right? So
Yep.
bullish momentum bet on itself. And now here we are. Since May 2nd, we've had good headline after good headline after good headline, and stocks are actually down 50 basis points. So to me, it's like the beast in the market, Craig, is saying, where's the beef, right? Where's the beef? In other words, a lot of these tariff deals are like preliminary sit downs into a deal, not
Yeah.
necessarily. There's still a lot of fog out there, not so much visibility. Is that your take?
Yeah. No, I think that's a good way to think about it. I mean, Liberation Day, April 2nd, comes out and it's much worse than what people originally feared. And so markets have a violent reaction to that. People really weren't prepared for the magnitude of the size of those reciprocal tariffs and then the acceleration of the China tariffs and the escalation of those tariffs. And so markets start pricing in very negative left tail outcomes. Things can get really bad very quickly. So to your point, then the administration, basically says, yeah, we don't really love that idea. And so we're not gonna do that. We're not gonna do the reciprocal on everybody. We're gonna have this 90-day reprieve. And so markets kind of breathe a sigh of relief. They rally back as the administration tamps down. And so here we are, basically a little bit, about a month later from the climb down and the removal and the 90-day window, and we're into a meeting this weekend between China and the U.S. to kind of decide what's next. And so I don't think it's that much of a surprise that we're digesting here. This counter trend move has been pretty big, but we're faced with this reality of the soft data has rolled over, but the hard data hasn't rolled over yet, and it's about to roll over. But if the markets keep rallying, the soft data is going to rally back up again. So I think next week is a crucial week. It's also options expiry week with this China meeting on Saturday, and so I think the next move will really be determined by how much of a climb down do we have in this relationship between the U.S. and China.
Yeah. And as you can see here in the chart, stocks are unched since last June. What's interesting, we talked to different technical people in the webs in the chat, and Craig, you run our Discord room. Anybody that wants to be in the Discord room, you're coming off a plane. You want to find out where markets are. Craig's right there for you in the Discord room with all of our institutions. You're coming out of a long meeting, get in the Discord room. Okay, Craig's a master at it. You're in there with buy-side investors that can walk you through. Can you go back to that chart, Jose? Yeah, so what we're seeing here is the S&P has rallied back to the September and I think it's September, October lows. And you're on the confluence of that in the 200-day moving average. This is a classic technical level of, if you go back to 2000 or 2008, these kind of violent moves. This is where the market should, in a bear market rally, this is where the market should roll over, because a lot of this is short covering. And at the end of the day, you have horrific, what we call soft data. And that's all that means is, we talked about that last week. So that's just the opinions of surveys and ISM and the regional Fed stuff. That's what people are thinking, whether it be consumer confidence. It's all soft. It's not hard. Hard data is actually economic data. But one of the clients said to me this morning, Craig, is the only way to merge that really bad soft data and with hard data the only way to make the hard data better is with clarity and visibility. And if you look at these deals, it's just a lot of fog right now. There's no clarity and how we. So to your point, next week's a big week.
Yeah.
What are we going to get in terms of visibility? And then
I-
then they had a deal with India, and then we have a war in India, which basically kiboshed that deal.
Right. No, unfortunately, I mean, my bias is that we're not going to get that certainty that the market is desiring yet. And so I think what we'll wind up seeing over the weekend is, agreement to de-escalate and agreement to talk further, but still a very elevated China tariff regime. Maybe it's 50%, maybe it's 80%, as Trump indicated this morning. And unfortunately, those are just levels that are going to put a huge damper on imports into the U.S. and the supply chain in the U.S. and retail's ability to procure products and retail, margins and the like. And so I think we're headed right now into the hard data rolling over. The negative impulse from some of this talk is finally hitting us. We've been monitoring the container shipments out of China. Not only the ships, but also the actual containers on the ships. And it takes 4 to 6 weeks for those boats to get here, to put them on trucks and the like. So the data it's now. It's basically over the next,
Right.
2 to 4 weeks, we're going to see the slowdown, and it's going to be hard for investors to say it's not here. And so if we only get a short-term alleviation between the U.S. and China to, continue talking, let's say in a month from now, that's just not enough certainty. And it's also too soon for the next piece of certainty, which is the tax cut bill, right? Where we've been talking to our DC connects about, some of the infighting between centrist Republicans and far right Republicans on the degree of spending, even the possibility of tax hikes on the wealthiest. And so it's too soon. And so we're not going to get certainty on trade. We're not going to get certainty yet, probably until the summer, on the budget resolution and the tax cuts. And so we're kind of in this malaise period here after this big counter trend move. It's going to be tough for the market to continue to move higher. Positively, we get the share buybacks. We know that that's always going to be with us. Some of these systematic flows, which we're monitoring, are underweight. So that's a continued grind. But unfortunately, the dollar really, I think, has been signaling weakness. And that hasn't really rallied back with some of the better market performance. And I think that's signaling this repatriation flow, this foreign capital outflow that continues. And I think ultimately that's a deciding factor here for the next couple of weeks as foreigners continue to sell, as uncertainty reigns. It's going to be tough for the market to keep plowing higher.
So one of the things thank you, Craig. One of the things we talk about in our book, How to Listen When Markets Speak, is, what are the kind of the sectors of the market telling us? In other words, everybody wants to see where the hard data is. But one of the things that Stan Druckenmiller reminds us of, we talk about this in the book, is that there are sectors which will price in good hard data ahead of time if it's coming. And one of them is the transports. Now, Expedia today, because CFOs have a much better visibility of real hard data they're on the front lines, right? If you're the CFO of Expedia, who's got better data than you, right? Who's got better data than the United Airlines CFO in terms of what consumers are doing? Now, as you can see here, Expedia missed this morning, stocks down 6-7%. As you can see here, big S&P rally, and still we just don't have much out of the transports. So you want to listen when markets are speaking. Right now, consumer-centric equities that are facing large swaths of consumers, like Expedia, like the transports, like JB Hunt. We'll get to that next. We're just not seeing a lot of kind of the market's not pricing in hard data right now. The S&P somewhat has, but a lot of that inside the market is short covering. Next one, Jose.
Yeah, and it's not surprising me with transports kind of being at the crux here of the container shipments, right? From port in China to port in LA, put it on a truck, send it to Walmart, right? So those truckers, the rails, they're going to be taking that product and moving it out throughout the country. The fact that the stocks are signaling weakness, it's the CEOs are out at conferences or on their earnings calls, kind of talking down forward guidance. And so it's not a surprise. This is where, we're seeing that hard data showing up. And so the question will be magnitude and for duration. How long is this with us for?
Yeah, and so now we want to look at, okay, what's subprime telling us? That's another leading indicator. If you look at companies, a firm today, stocks off a lot, like companies that face what we call subprime borrowers, right? And so we saw this in 2007. We're not saying this is a 2007-8 situation, but it's similar. Subprime part of the market is leaking oil here. As you can see, credit acceptance, really no rally with the S&P. Stocks down a lot, well off the old highs. So that's one of your largest subprime lenders in the auto space. So you want to look for things like that. Like if the economy's healthy, subprime lenders, should be outperforming, right? And that's typically what happens in a beginning of a bull market. Your triple C's in high yield or your subprimes, that's those types of parts of the market will
Yeah.
typically outperform in the beginning of a bull market. Let's keep moving those through. So Craig, in terms of different parts of the market, like different parts, let's keep those slides going. What other parts of the market are you focused on?
Yeah, I mean, for me, I think we're also seeing in this counter trend move. And here you have, Capital One, which is another one of these, you know, lenders that faces more the consumer. It's not the highest end consumer, and so yeah, look, that's the areas of the market that stalled out first as the K-shaped economy struggled, as more people were finding themselves in the lower part of the K-shaped economy. Those things unraveled first towards the end of last year and the beginning part of this year, while the S&P was continuing higher and making new highs. Those rolled over first, and then what we're seeing now is on the bounce back, they're still lagging, right? If things were firmly turning around and the economy was good and we were about to reaccelerate growth, those things would have started to outperform and would have started to lead. But the fact is they've lagged on this bounce back up, which I think also suggests that we're not out of the woods yet here.
Yeah, and for Capital One, there was a merger there that was completed with Discover. That's helped that situation. But you're trading at 1.2 times book, and the street believes that's a game-changing merger. One of the things that's interesting is Trump made a promise to voters in the fourth quarter of last year to cap credit card rates, and so far the Trump team has not done that, and it is actually this last 10 days helped some of the credit card companies with kind of looser credit standards. So that's helped some there. I think on the Walmart side, one thing that clients are pointing out: earnings here on the 15th of May. You have a very bearish MACD roll there. You got RSI rolling over, head and shoulders. This is classic case where everybody's hiding out in staples. Walmart back up near the highs. Ugly price action this week, later in the week. That's a big retailer coming out next week with earnings. So a lot of people are saying, okay, that's something you want to keep an eye on, Walmart, because it's the largest staple pretty much out there. And once again, people are moving into what we call recession resistant stocks. That's a sign of behavior in the market of typically before recession. When recession resistant equities outperform, whether it be Philip Morris or Walmart, it's a sign that people want to hide out in parts of the market that are viewed as safe in recessions. Craig, this week, several clients in the Midwest pointed out potash companies, ags. I mean, these agricultural names, Mosaic, they're all outperforming. This is, once again, this all bullish parts of the market. This is incredibly bullish price action. And as we have that rotation from growth to value into commodities, what are you hearing on the ag
Look,
space?
I think it's a reminder. People are going back to kind of the first trade deal with China and China's desire and ability, and said they would buy a lot of agriculture products. People are remembering, how robust the U.S. agriculture sector can be, and that farm exports are going to be a big part of whatever trade deals we do. We saw yesterday with the UK, just beef exports, right? And other things that, opening up new markets for American farmers, right? This is a big deal. People remember that. And so when you combine that with the weak dollar and kind of constructive pricing for commodities, people are looking for those U.S. related commodity exporting facing companies, agriculture and agriculture input companies like Mosaic, like Potash, like Compass fit perfectly And so these are, these stocks have really started to show a lot of relative outperformance, and now, absolute performance, as the outlooks are going to start looking better, with American farmers being kind of at the foreground of, resurgence in U.S. export activity. It's not manufacturing jobs like Trump says he wants. In the interim, it's opening up, markets for farmers, and so people remember that, and they're playing accordingly.
Yeah, and that move from what we call financial assets to hard assets. Here you can see, to me, this is really bullish. When you have a breakout in the gold miners, this week is another thing. We just got off the phone with Adrian Day, one of our contributors in the chats. We run a live chat on Bloomberg and on Discord. One of the things that's interesting about the gold miners this week, Barrick, there's a number of companies quarterly that reported, and over the last year, a lot of these companies have had quarters with noise and cost overruns and really disappointing earnings, especially Newmont. And a lot of that is like kind of kitchen sinking and getting these kind of costs out of the way. But now you're coming in a period where the earnings are actually outperforming this week. So the gold mining space earnings. So we think here with the GDXJ, you had that breakout and the consolidation, and a lot of those stocks in that space are really cheap relative to the market, relative to where gold is, right?
It's just,
so,
gold mining or mining in general has been such a frustrating way to get exposure to the commodity. It's just been easier to play the commodity outright. But, now that we're into, 4, 5, 6 months in a row of just stronger and stronger gold price, it's harder for these guys to even screw it up, right? I mean, they're getting a lot of leverage to these commodity prices, and I think the equity market investors also recognize that with a low oil price, right, the gold to oil ratio has exploded, which is hugely beneficial for mining companies. And so when you have that gold to oil ratio move higher, that's just margin expansion for gold miners. And so finally, in that environment, gold mining sector stocks can actually pick up the slack and actually do what they're supposed to do.
And so what's happening is inflation's normalizing at a higher level. Tariffs are making that, bringing that fear on. You look at the dividend discount model, discounted cash flows in the market. People are moving from growth stocks. NASDAQ 100 had 27 trillion in February. Now it's close to 24. So that money's going somewhere. And as you can see here, we're still, I think, 18% off the highs from Mag 7, whereas other parts of the market are capturing that capital flow. And this is really important because this is that counter trend rally. And if we're failing here on the Mag 7, that's a sign that, you're going to have lower highs for that group as money moves out of growth into value, out of growth into commodities in a multipolar world with trade wars and tensions between all different types of countries and higher inflation, higher bond yields. This is the main thrust of the book. I mean, and remember, I'm really proud. Craig and I and the team put this together 2 years ago, 2.5 years ago, and the whole concept is this great migration, because at the end of the day, all of the oil stocks combined, oil and gas are literally 1/3 the value of say an Nvidia. But here, back to the transports, JB Hunt. You can see here, everybody's hiding out in the staples. Q's rolled over. JB Hunt, your big truckers are not, kind of bouncing with the market. So that's another thing that you were talking about earlier, Craig.
Yeah. No, I think we're seeing kind of classic rotation in the market ahead of a slowdown or into the teeth of a slowdown, with utilities outperforming, with staples outperforming, with defenses largely outperforming. I mean, normally healthcare would be part of that, but because of the RFK dynamics, you're losing kind of healthcare as a place where people can feel comfortable hiding money. Biotech has been absolutely destroyed on some of the stuff coming out of RFK and the recent announcement from, out of who the new FDA person will be. So, less place to hide, which has led to more outperformance for staples and utilities. But look, I think over the course of the next couple of weeks, if we start to see that hard data roll over, we're going to get we will get broader flows out of U.S. equity markets and more rotation into. I see we have here, Brazil has been a place where people have been starting to rotate into for the first time in quite some time. And some of those other emerging markets and other markets, global markets generally, are starting to pick up some of those flows.
Yeah, and what's interesting, Craig, here is that you think about like when markets are speaking, Now, so you have this big move in the ags this week, um, coupled with the big move in Brazil. We had about 10, 15 days ago, we had an ideas dinner in Brazil. There were a number of really polished, well-respected asset managers that we've known a long time pounding the table on Brazil. We've done a number of trade alerts on Brazilian equities over the last several months. The Brazilian banks were ripping this week, Bradesco, ITUB. And so you have an election next year. Like you said, you have a potential trade deals with agriculture involved. You have a central bank in Brazil that's potentially going to start cutting rates. You have an election next year, like I said, that could go a market-friendly way, similar to what happened in Argentina. And then you have that weaker dollar and all that money moving out of U.S. equities that needs a new home. Remember, investors globally are 2 to 3 standard deviations higher than the 30-year mean invested in U.S. assets. That's a fact. And there's from what we hear from and we've been saying this for 4 weeks now. There's a mandate globally as asset allocators, as people that position capital. They're being kind of gun to the head. They're being ordered to take down dollar exposure. And you can see the capital flowing into the Aussie dollar and the Brazilian real, into equities. And just look at the EWU, for example, versus the S&P or the NASDAQ. That's your global basket of big commodity type companies. Or look at it today, the German DAX back on the highs, with the NASDAQ and the MAG 7 18% off the highs. So there's clearly a massive transition rotation going on here. I think that's a good way of wrapping it up. Pick up our book. Craig, any closing comments? Like, have a great weekend with the family. Mother's Day. Get the flowers. We're going to get the flowers today. Right?
Absolutely. No, I appreciate that. And same for you and your family, Larry. But look, next week's going to be very important with the China meeting. Trump's also in the Middle East all next week. Plenty of talk about, potential headlines with trade deals with Saudi, with UAE. What's oil going to do? Are we going to sell weapons? And then on the tail end of that, where is the relationship with Iran? How does Israel fare in? Right? It's middle of May. There's and then you have the old adage of sell in May and go away. So I think next week's gonna be a crucial week. It'll really be. It's not surprising the markets are where they are, kind of at critical technical levels, into a critical geopolitical week. So we'll keep our head on a swivel, and we'll be all over it in the.
That's
we'll
a good.
I forgot
we'll
be all over it in the Discord.
Sell in May.
That's right. That's right.
Sell in May and go away while we're on the 200 day. Oh my God. But get in, join Craig in the Discord room. Reach out to info@thebeartrapsreport.com. Team, if you could put up our email. I want you to put up the email on a regular basis through the presentation here. But if you could put up info@thebeartrapsreport.com, where people can reach out, get into the Discord room. Craig can be there with you all week. And thanks very much, everyone.
Great. Thanks, Larry. Take care.
Thank you, Larry. Thank you, Craig. Thank you, everybody, for joining us this week. Remember, we host a live institutional chat on Bloomberg, and we have more than 600 investors all around the world. We also have a Discord platform live just for you. We also have daily reports, weekly reports. We have the Turning Point, the One Idea. If you're interested in any of our services, please reach out to info@thebeartrapsreport.com. Larry and the team will be in New York in about 2 to 3 weeks. So if you're interested in joining us in our events, also reach out. We'll be in the West Coast around mid-July, and we'll be looking forward to seeing you. Also, remember, you can pick up our bestseller, How to Listen When Markets Speak, on Amazon. Right now, we're posted in Chinese, Korean, and Portuguese. So get yours now.